Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics or Finance Excellency Batch. I'm here, your mentor, your guide, CS Saurav Jindal from KSJ Teaching. So let's continue with our session. Okay, so what we have been discussing about, the demand for money, and in the last lecture we started with the theories of demand for money, and I told you, sir, what? That in this particular video we are going to discuss our liquidity preference theory. In the last lecture we discussed about the QTM, that is the quantity theory of money, then we discussed about the neoclassical or the Cambridge approach, then we discussed about the inventory approach, right? So these were the three theories that we covered in the last lecture, because I told you that this particular one, this liquidity preference theory, is quite a bigger one, so we will be taking it up later on, right? So in this video we are going to take this up. Okay, let's see now what does the liquidity preference theory has to say. The first thing, the liquidity preference theory was given by Keynes. The Keynes theory of money demand is known as the liquidity preference theory. So it was given by Keynes, right? So he was one of the most intelligent economists, I would say, right? Because he has given a lot of things. He has given the theories regarding the national income, a lot of concepts regarding the national income. Then he has given regarding the money demand. So he was, one of the most renowned economists. Liquidity preference refers to the people's desire to hold money rather than securities or long-term interest-bearing investment. Now try to understand this. Now what does this theory says? Liquidity preference. As the name suggests, liquidity preference means to hold cash, right? Why people want to hold money as cash, right? If you look at this word liquidity preference, that means preference to hold cash, that is liquid money, hold cash, right? Now Keynes says why people want to hold the cash, right? What is this theory? Why people prefer to hold cash? What are the various reasons behind it? He says majorly there are three reasons which I have already told you also. He says people hold money for majorly three reasons. One is the transaction motive. Another one is the precautionary motive. The second is precautionary motive. And the third one is speculative motive. Right? Now he says, obviously, people need money for day-to-day transactions, right? You are getting a salary and there is always a time gap between the receipt of the income and the expenditure to be done. So people need to have some money in the pocket for the transaction purposes. The people need to hold cash so that whenever they receive the income, they want to hold cash so that they can do the transaction as and when required, right? So this transaction motive is, it is for carrying out day-to-day transactions, right? It is for carrying out day-to-day transactions. Obviously we need money, right? And because there is a time gap between the receipt of money and the expenditure to be done, that means, let's say you are getting your salary on 1st of April, right? And the expenditure is to be done over a period, right? Let's say till 30th of April. You need to hold cash for this period so that as and when required, you are able to do the expenditure, isn't it? So this is the first motive, that is the transaction motive defined by Keynes, right? Now he says, so this function was given by LR, that is the demand for money. He says it is dependent upon KY. I think it is KY which is given. Let's see. Yeah, KY. Now, what is Y? Y is your total income. Y is your total income. Now, K defines that out of this total income, how much of the money you want to hold as cash, right? How much to be held as cash? How much to be held as cash, right? How much to be held as cash? This is your demand for money. So he says the first purpose of this demand for money is whatever the cash you want to hold for your day-to-day transactions out of your total income. Obviously, that will be the demand for money, isn't it? That much money you will demand. After that, what is the second motive? The second motive is the precautionary motive, right? That means you need cash, you will demand cash for any future contingencies. Demand of money for future contingencies, right? Demand of money for future contingencies, obviously, sir, right? So this is what is given here. Let's read it till here. According to Keynes, the people hold money for three motives: transaction, precautionary, and speculative, right? So demand for money is the sum total of all these three motives. Transaction motive is it represents the need of cash for the current transaction for personal and business exchange. This need arises due to the timing difference and the lack of synchronization between the receipt of income and the planned expenditure. That is what I told you. The receipt of income is on 1st of April and the planned expenditure is during the month. So you need to hold money for that expenditure, right? After that, he says, this motive is further classified into income motive, that out of the total income, how much how much of that income the individuals or the households want to keep for the transaction motive, and the trade motive is that out of the total earnings, how much of the income the business firms want to retain for the further exchange of goods and services, for buying the raw material, then converting it into for any of the business purposes, basically, right? So transaction demand is a positive function of level of income and unaffected by the interest rate. Whatever the interest rates are prevailing in the market, right? We anyhow need money for the day-to-day transactions. Whatever is it is dependent upon now the level of income. It is directly relational to the level of income, but it is not dependent upon the interest rate. Now, what do you mean by interest rate here? Interest rate here is whatever the interest rate the bank or any other securities are going to give you. Let's say if you are earning here, let's say if you are earning here 50,000 rupees. Now, if you invest this 50,000 rupees, you are going to get 10% interest rate, right? But if you need 50,000 for your for your day-to-day transactions, sir, how can you invest this? Can you invest it? No, sir. So it is not dependent upon what rate of interest you are getting, because you anyhow need that money to be held as cash for your day-to-day transactions. Clear? Any doubts? After that comes this. So this is transaction demand for the money is given by LR, that is the demand for money, is equal to K and Y. K is the ratio of earnings kept for the transaction motive and Y is your total earnings, right? Precautionary motive, it denotes the money kept aside for financing the unanticipated expenditure, right? So future is always unanticipated. The future you cannot predict that what is the situation going to be in the future. Will there be any monetary demand in the future? Any medical emergency can be there, anything can be there, right? So the example is medical emergency. The amount of money demanded for the precautionary motive depends upon the income level, economic and political conditions, and the individual's personal characteristics, etc., right? So let's say one person is of the nature that he says that I want more and more of money to be kept as a precaution, right? Because that person is really fearful that in the future this might happen, so he wants to keep more money. And another person is really risk-taking capability he has, right? So he says, let's see, whatever happens in the future, I'll keep just a few amount of money for the future, and the rest of it I will invest in the other securities, right? So we say the demand for money, the precautionary demand for the money depends upon the various factors, right? If the economic and political conditions are not that good, like during the COVID, right? The people kept more and more money for the precautionary motive, because the people were into the fear that in the family someone might catch COVID, then hospitalization expenses might be there, other medical expenses can be there. So the demand for money during this period increased, right? The precautionary demand for the money during this period increased, right? So that is why we say that it is dependent upon the various factors. So precautionary balances are income elastic, that is, they are dependent upon the income but not affected by the interest rate. Again, they are not affected by the interest rate, because if a person says I want to keep 50,000 at home for the precautionary reasons, then whatever the interest rate the market is providing, that person will be unaffected by that. But whatever the amount of money he is keeping as precaution, right, as a precautionary motive, that is dependent upon the income. Now, if the income of the person is 40,000, can he keep 50,000 as the precautionary money? No, sir. Right? So it is dependent upon the income, but it is not dependent upon the interest rate. Clear? So this was the second motive, that is the precautionary motive. Now comes another one. Very, very important. This is very, very important. Just try to understand very carefully. Speculative motive. Right? Now, what is speculative motive? Speculative motive says a person can hold money in two forms. One is in the form of cash and another one is in the form of interest bearing assets. Another one is in the form of interest bearing financial assets. Right? And these assets are called as bonds. He has mentioned these assets, named these assets as bonds. Right? Now, if you are keeping money in your pocket as a cash, is it going to give you some return? No, sir. No return. Right? And if you are going to invest in the bonds, will there be income or will there be return? Yes. Return in the form of interest. Return in the form of interest. Right? Now, the speculative motive says that this person, let's say there is a person A, he is holding the cash right now, right? Why is he holding the cash? Because he wants to invest in the bonds at a particular time when he can gain out of it. When he can gain out of it. Let's take two situations. Let's try to understand. Let's say there is a situation 1 and this is situation number 2. Now, what is going to happen in situation 1? Let's see. What will happen in situation 1? Here, the bond price is rupees 100, right? And the interest rate on this particular bond, interest rate is what? That means the return on that bond, right? The bond price is 100 and the interest rate is, let's say, 15%. In the second scenario, we say that this bond price is equal to rupees 200 and the interest rate is 10%. So first thing that you have to remember here is that the price of the bond and the interest rate, they are inversely related, right? When the price of the bond will be low, interest rate will be high. On the other hand, if the interest rate is low, the bond price will be high, right? So what we say that bond price, this thing you always have to remember, bond price and interest rate are inversely related, right? Now you will be able to understand why we say this, right? Okay, so this is situation 1 and this is situation 2. Now out of these two situations, you have to tell me that what will happen in the situation 1 and what will happen in the situation 2. Let's consider yourself to be an investor. Now in this situation, what will you do? Sir, in this situation, you will purchase bonds. You will purchase bonds, right? That means why you will purchase bond? Because the bond price is lower, it is 100 rupees and the interest rate, that is the return that you will be getting on this bond is higher, that is 15%. So at this price, what will you do? You will say, let's purchase the bonds. Why? Because at this point, what you are anticipating, that this is the highest interest rate that you can get on this bond. After that, this interest rate will start falling, and when the interest rate will be falling, the prices of the bond will start going up. So he says this is the right time. Bond prices at the least, lower bond prices, higher interest rate. let's purchase the bonds, right? If you have 10,000 rupees, how many bonds you can purchase here? 100 bonds you can purchase. So you will say, let's buy these 100 bonds. Let's buy these 100 bonds for how much? 10,000 rupees, because each bond is priced at 100 rupees, and you will get the interest at the rate of 15%. Now, when you are going to purchase bonds, that means your money holding will be less, right? Less money holding as cash. Less money holding as cash. This much is clear? Right, sir? So when the bond price is low, interest rate is high, then you will say return is high, price is less, let's invest. Here you are getting the 100 bonds. Now, what will happen in the situation 2? What will happen in the situation 2? In the situation 2, let's say you have 100 bonds, right? Now the interest rate has fallen. Interest rate has fallen. That means your return is down now. Earlier you were getting 15%, now you are getting 10%, but you can still play the game. How? You have 100 bonds here. What you will do is you will sell the bonds here. Here, what will you do? Sell 100 bonds, right, at the rate of rupees 200 each. So what is the amount that you will be getting? You will get 20,000 rupees. So you invested 10,000 rupees. Now you are getting 20,000 rupees. What is this known as? This is known as capital gain. This is known as capital gain. Sir, even if the interest rate was lower, your income was on the lower side, your return was on the lower side, then you played the game by attaining the capital gain, right? You sell the bonds at higher prices of the bond. When the interest rate is low, you will sell the bonds and convert it into cash. You will hold cash, right? Because in the future, now what will happen? You are holding this 20,000 as cash. Here you will have more cash holding. Now try to understand what you are going to do. Sir, you will hold this 20,000 by selling the bonds. You are getting 20,000 rupees as money. You will hold this money with the anticipation that in the future, again, the bond prices will go down, interest rate will go up, and at that time, I will invest 20,000 rupees. Right? So that is the speculative motive, that you are holding the cash with the motive of speculation, that whenever the prices of the asset will go down, interest rate will go up, I will invest, right? And when the prices of the bond go up, interest rate go down, I will sell it, hold it as cash, right? So this is the whole flow chart that I have explained it to you, and this is what is written here under the speculative motive, right? So speculative motive, let's read. It reflects the people's desire to hold cash balances to be able to exploit any attractive investment opportunity that requires expenditure in the form of cash. That is, to take advantage of favorable business situation. What is that favorable business situation? When the bond prices go, you are having cash and you are waiting for the bond prices to go down so that you can invest at that time when the interest rate is higher, bond prices are lower, right? It means the proportion of the cash in the asset portfolio in response to changes in the interest rate. So when the interest rate is higher, you are spending the cash, you are holding the less of cash in the asset portfolio, and when the interest rate falls, you are holding more of cash in your asset portfolio. The asset portfolio here means the cash and the other interest bearing financial assets. So the rate of interest refers to the return on the bonds. Higher the interest rate, lower the speculative demand for money, and vice versa. This I have already explained. Now, people or the firms hold their wealth in two major forms: bonds and the money. Expected return in the form of interest, cash flows, and the capital gain. In case of money, the expected return is zero, already explained. The market value of the bond is inversely related to the market rate of interest, already explained. A rise in the market rate of interest leads to decrease in the market value, and vice versa, because they are inversely related, already explained to you, right? Any doubts in this thing? Clear? After he says, now there are three parameters that he has taken. One is the normal or the critical rate of interest that is defined by RC. It is the rate of interest based on the investor's expectation, that is what you are expecting from that bond, what is the return that you are expecting as an investor, right? That is defined by RC. Then another thing is defined by the current rate of interest. Current rate of interest is what currently the market is providing as the rate of interest. Then maximum and minimum, that is the upper and lower limits of the market rate of interest, that it can go up to what limit and it can go down up to what limit. This is the maximum and the minimum level, right? Maximum rise and minimum fall of the market rate of interest. Clear? Now this table is important. Now he says when Rn is greater than Rc, that is the market interest. Try to understand, market rate of interest is greater than expected rate of interest, right? Now at this point, what will happen, sir? At this point, what will happen? That means market says the rate of interest is 15%, right? Market says the rate of interest is 15%, whereas you are expecting, this is RC and this is RN. This is what is defined here. You are expecting that the rate of interest should be 10%, right? Now, what will you expect? You will expect that this 15% will start falling. That 15% is the maximum limit which the market can provide. Now, this 15% will start falling. That means interest rate will start falling. Now, what will be the consequence of it? At this price, the bond prices will start increasing. Bond prices will start increasing. So what will you do? What will be your action at this particular level? What will be your action? He says the bond prices are expected to increase. Why? Because there is an inverse relationship between the interest and the bond prices. If the interest rate starts falling from 15 to 10%, the bond prices will start increasing. So what will you do? Sir, you will put all your money in the bonds and not hold as cash. Convert all the cash balance into bonds. Expectation is the fall in the interest rate. Now, if the interest rate will fall, the bond prices will rise. That means currently the bond prices are lower. So what will you do? You will invest more in the bonds. That is what I explained you. This is this situation one. Interest rate is higher, bond price is less. Now, what will you expect? You are expecting that this interest rate will now come down and the bond price will increase. So why not put all the money in the bonds right now, right? So this is particularly what? This is your situation number one, which we have discussed. So reason is earn the high rate of interest on the bonds and the capital gains resulting from the rise in the prices. When the bond prices will increase, your capital appreciation will be there. So in the asset portfolio, there will be bonds. The reverse will be applicable when the market rate of interest is less than your expected rate of interest. Now, the market is providing, RN is providing 10%, whereas you are expecting 15%, right? That means what will happen? At this particular rate, let's say your bond price, at this particular rate, let's say your bond price is 200. Now, what will you expect? You will expect that this will start increasing. Right? This will start increasing. Let's say it increases to 15%. Now what will happen to the bond price? Sir, the bond price will come down. With the rate of interest increasing, the bond price will come down. Let's say it comes down to 100. So at this situation, what will you do? Sir, you will sell your bonds. Sell your bonds and convert into cash. Right? What will be the result? The result will be capital gains. So rise in the interest rate is the expectation. Hold all their wealth in the form of liquid cash, that sell the bonds, convert everything into cash, hold the cash. Loss, as the interest foregone is small, anticipated capital losses is avoided, the idle cash held can be used to buy the bonds at the lower price and can thereby make a capital gain, right? So whenever the prices fall, that cash which you have converted, which you are holding, you can use that cash at that time. The return on the money will be high than on the bond. So everything should be held as money. Now there comes a question. He says if Rn is equal to Rc, then what will happen, sir? if Rn is equal to Rc, then the user will be indifferent to holding either the cash or bonds. Then it is his choice whether he wants to hold everything in the form of cash or he wants to hold everything in the form of bonds. That is totally your choice, right? So individual speculative demand, that as the interest rate, what will happen, sir? Here the money or the bonds is there. This is the market interest rate. This is your expectation, right? This is what? This is your expectation. So the market interest rate falls, right? The bond prices will move up, right? So this is how this individuals speculative demand. You are expecting this. The market is providing this. Now you are expecting that this will start falling, right? So when the market rate of interest will start falling, what will happen? The bond prices will start increasing, right? If Rn is greater than Rc, the entire wealth is held in the form of bonds. If Rn is less than Rc, then in the form of cash and money. The aggregate speculative demand, nothing as such much. He says the speculative demand for money, this is the maximum rate of interest, this is the minimum rate of interest. At one particular point of time, this line will be flatter because something you will be investing, right? So in this case, the discontinuity of the individual curve disappears and a continuous downward sloping function, that as this interest rate falls, right, the bond prices, this is what rate of interest, as the interest rate is falling, right? So what will happen, sir? Your speculative demand for money will increase. Why? Because the bond prices are high. You want to hold more and more money in the form of cash so that you can spend when this interest rate is higher and bond prices are low. So this chart, what is this chart depicting? That when the interest rate is falling, R max to R minimum, your speculative demand for money will increase, right? This is what is told here, that when the interest rate is falling, interest rate has fallen from 15 to 10%, your holding for cash, right? This is demand for money basically. Your demand for money will increase. This is your demand for money. This will increase. This is what this chart is depicting, right? Showing the inverse relationship between the interest rate and the demand for money. As the interest rate is falling, your demand for money is increasing. Clear? I hope I have tried my best that everything is clear related to this particular approach, because this is one of the most important approaches, right? So we are done with the transaction motive, we are done with the precautionary motive, we are done with the speculative motive of this particular approach given by Keynes. And as we can see, Keynes has given some of the most important aspects of the economics, right? Isn't it? Now, in this part only, there is another concept in this theory only, that is known as liquidity trap. That is known as liquidity trap. Now, what is this liquidity trap? Try to understand. Very simple concept. We says when the interest rates are at the lowest, right? Let's say there is 2% interest rate only. Maximum is 10% rate of interest. Maximum is 10% rate of interest. Now what we say? Sir, we say that at the low rate of interest, people prefer holding more money as cash, right? Instead of investing the money. Why? Because they are losing only 2%. The opportunity cost is not that high. They are not losing 10%. At this level, opportunity cost is very low. Opportunity cost is very low, and this line indicates the speculative demand for money will increase. That means the people will prefer holding more and more money in the form of cash, right? Now, what is this liquidity trap says? The liquidity trap says this is a situation of liquidity trap. Why? Because even if a government tries to stimulate the economy, government tries that this rate should increase, right? Government tries to stimulate the economy, the government will not be able to. Why? How will the government stimulate the economy? Government will increase the money supply in this situation, right? Let's pump the money into the economy so that there is a circulation of money. But what will people do? People say, if the cash is coming, let's hoard everything, right? So this liquidity trap is what? That people will hoard money. People will hoard money right? Even if government increases, even if government increases expenditure, government increases money supply, right? So what is the result of it? The result of it is unable to stimulate or increase the growth of economy, unable to stimulate economy, right? When the interest rates are low and the people's speculative demand for money increases. Now people want to hoard everything. People want to keep the whole of money as cash for the future transactions. Of future transaction means the speculative transactions, not the other future contingencies, but for the speculative reasons they want to hold the money, right? So at that point it becomes really difficult for the government to stimulate the economy. This situation is known as liquidity trap. Clear? So we are done with this particular theory also, and now we are left with just two theories or two topics, we can say, right? Two theories. One is the Friedman's theory, another one is the demand for money as a behavior towards risk. Very simple theories which we will take up in the next lecture, right? I think that's enough for this because it was quite a heavy theory that we have discussed today, and you people must be needing that rest, a relaxation of the mind after that particular theory. But one thing I will say before we sign off, that this particular flow diagram or this particular chart is really helpful, going to be helpful in the explanation of this theory of liquidity preference theory. So please make this chart and keep this chart with you for the revision purposes also, right? So that is why I prepared this chart, so it becomes easy for you people to understand this theory, right? Because this was one of the lengthiest theories of the theories of demand, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.